Trevor, it is good to see you. Just now during commercial break, we were joking about how 2020 really has been kind of a disaster, right? And you've been coming on the show from the very beginning, almost 4 years now. You've talked about this concept of diversifying your portfolio. And oftentimes, when we're talking about investments, it's sort of like speaking another language for a lot of people. So really just break it down to the basics. What are we chatting about?
Yeah, no, I hear that a lot, Derek. And one of the things I hope to do on Finance Friday is really simplify so people can, understand what they need to be doing with their money and their investments. And so the first thing I just want to point out, Derek, a lot of people don't know this or they wouldn't believe it, but right now, the S&P 500 in the market is essentially flat for the year. After everything we've been through, believe it or not, if you invested on January 1, you would basically be right where you're at now. And that's a shock to many people. So this is a great time to pause. What happened to your portfolio? Like what actually happened over this crazy, 4 or 5 months? And so what is diversification? It just means not having everything in one basket, not just everything in one company. You need to have a multitude of different investments that hopefully spread your risk out, allow you to target a good rate of return, but reduce your risk as much as possible.
And how would someone know if they are maybe not diversified enough? You just mentioned that the market has sort of, a lot of people's accounts maybe look exactly now as they did 6 months ago. But how would we know if we weren't diversified enough? Would we actually see a decrease in our accounts right now compared with 6 months ago?
Well, I think the main point that I would ask the viewers is, did your portfolio and investments do exactly what the market did? So if you go back to the end of February, we were all riding high, and then it went down exactly with the market, 35%, and now you're right back up. You may not be diversified because you're just following the market, basically. You need to have different types of investments that zig when the market zags. Make sure you've got a multitude of different things, and that's why I'm advocating, take a look, get a second opinion, go to another advisor, make sure that you've got the right mix. Now's the time to do it.
Okay, so get a second opinion, maybe even better, get multiple perspectives to weigh in to ensure that your accounts look the way they should. Let's talk about what people are actually invested in. Diversification by location. Essentially, you mean there are ways to think that you are diversified without actually being diversified, and it all boils down to your advisor, right?
Yeah, exactly. So a couple mistakes on the next 2 points I see a lot. Number one, people will have multiple accounts and advisors and think they're diversified, but what they've really done is they've just diversified by location, but they still own the same thing in every single account. Like Apple, for example. If you own the same fund or the same set of companies in every account or with every advisor, you're not really diversified. So that's my point. True diversification means having a mix of different asset classes and investments.
Is there anything or any such thing as over diversification, Trevor?
Yeah, absolutely. I see this one a lot too. So again, just having 1,000 different companies or say 60 different mutual funds, that can be over diversified. You really only need maybe 12 or 15 different index funds or mutual funds, if you will, to get really diversified. So remember, with investing, you don't want to just have a bunch of stuff that you can't track. You need to be consolidated and simplified so you can really stay focused on your long-term financial goals.
And you mentioned, I believe in our second point, about what was happening to people's portfolios in April. If we've been seeing our portfolios zigzag, up and down, and this applies to anyone, right, with investments, a 401k, whatever type of investments you have, let's not forget about real estate, because while there is a lot of volatility in the stock market, real estate seems to have been proven to be a little more stable. Is that true?
Well, look, I'm a big advocate of real estate. That's what we're doing now at Shakiba Capital. So I might be a little bit biased, and there is no perfect investment. But what you want to have is different asset classes that react differently. So real estate can provide control and stability in times of duress, especially housing, single-family rentals or apartments, which I'm a huge advocate of. Basically, what I'm trying to really convey here, Derek, is to find the right balance. For the viewers out there, find the right balance that fits you And now's the time to do it because we've had one heck of a 6-month period all over the place, incredible volatility. Pause, look and see if you need to make adjustments. And look, 2020 is not over. We still have an election coming up. So make sure you've got the right allocation and make sure you're prepared for the rest of the year and targeting those really important goals moving forward.
And Trevor, before we let you go, I mean, you've always told us do not make financial decisions emotionally, right? So if we see the market going down, don't panic and pull out your investments, right? Let's just look at the other side of that coin, though, and say, you know, there are a lot of people out there who just would prefer not to look at their account. Maybe they're not as diversified as they should be. Their money is just sort of sitting there, maybe creeping along, getting a little more return on their money. What about people like that who just are not, I don't know, just paying attention? I guess that's a terrible way to phrase it, but how much attention should we be paying?
Well, Derek, I think you should be paying extreme attention to your money when it comes to your investments and building wealth towards your, you know, those financial goals that you care so deeply about. But look, you don't want to make decisions based on emotion, but a very close second would be, not paying attention to it. That's where finding someone you trust that is an expert, like a certified financial planner, can really be so important. Get that second opinion, interview multiple advisors, make sure they're a CFP, and lay out that plan and get going. But yeah, just keeping a ton of money in bonds or in cash, not knowing what's going on, is a critical error. So I would advise everyone to make sure you pay attention.
Yeah, the right advisor is going to cost you a little bit, but they can also make you a lot of money on that back end. Trevor Shakiba, thanks so much.